that there's fraudulent activities taking place. With respect to the required risk assessment, one of the things that the standards kind of talk about is just presume that revenue recognition is a fraud risk. Right? So presume that if fraud is going to occur, right, especially management fraud, that management is going to try to recognize revenue in advance of when they should be recognizing it. Right? So that the revenue recognition is problematic. So assume, and in fact, the research shows that most times when companies are committing fraud, it's in the revenue area is one of the major areas where fraud is going to be committed. So the standards say kind of assume that revenue recognition is a high risk area and a greater susceptibility to fraud. When looking at internal controls, you want to make sure you focus on the tone at the top, and we're going to talk about internal controls today. The tone at the top is very important. What message does management send to employees about internal controls? How do they deal with internal controls? How do they respond to reports that the internal audit department, if they have an internal audit department, how do they respond to exceptions that have been identified by the internal audit department? And how do they deal with that? What are the repercussions if, for example, people are not adhering to the company's standard of internal controls? So what's the tone at the top? Does management override controls? When you do your ACL project, I think there is an exercise in there that requires you to look at journal entries or generate a list of journal entries, trying to identify any unusual journal entries, any unusual adjustments. So if you consider the fact that in most accounting systems, right, we're in a computerized environment, right? So most of your journal entries should kind of be standard, right? Every month you should see an entry posted to the general ledger sales account, right, as a credit, and that entry should be coming right from the sales journal, right? Cash disbursements. The credit to the cash account should be coming right from the cash disbursements journal, cash receipts, right from the cash receipts journal. So you should see basically an entry a month, right, hitting those accounts. What you're going to be concerned, so you should be able to pick up the general ledger, scan the general ledger, or use ACL and run a query on the general ledger to see what are the postings to the cash account, right? And if it's coming from the cash receipts journal, then there should be 12 postings, right? Every month you post. Sales journal, you should see 12 postings, credit to the sales journal. To the sales account, right? So what you're scanning is, are there any topside adjustments? Because management does have reasons to make topside adjustments. Those should be anomalies, and those should be few. So you want to examine any unusual adjustments to the general ledger. Any accounting estimates, and again, remember when I talked about management fraud, one of the areas that if managers are trying to manage their earnings or improve the financial position or picture that they're presenting to the public, then the way that they're going to do it is within the bounds of GAAP, right? Because GAAP does allow them this flexibility. And usually you'll see it in these accounts where there are estimates, where that requires a lot of judgment and estimates. So you want to look at those accounts very closely, because you're not going to get an external document that says the allowance for doubtful accounts should be X, right? There's no external document that you're going to get to suggest that the allowance for doubtful accounts is right. You can't confirm the allowance for doubtful account. There's no third-party evidence. There's no third-party evidence for obsolescence reserve, right? So you as an auditor are going to be put in the position of really evaluating management's judgments about these accounts. And part of your planning risk assessment is thinking about what are the incentives that management have to create, to manage earnings. What biases do they bring to that account in terms of how you evaluate that? And then what about any unusual transactions, any related party transactions? What's the business rationale for those transactions? So transactions that are outside of the company's normal operating you know, procedures that, you know, why are they involved in those transactions? So you want to think of those things. So in essence, what you're doing is identifying what the significant risks are. So again, if you think about the planning process, think about the information that you're collecting in the planning process. This is helping you to identify these risk areas, to be better informed about these risk areas, to be able to identify anomalies. So that is why the planning process